Greetings, comrades. Our task here today is we're going to complete these 5 general ledger accounts on the right so that we can determine our final balances before theoretically we would prepare a budgeted balance sheet at the end of August 25. Our material is we have a balance sheet at the end of the previous period right here on the left, and a bunch of additional information here that we need to factor in when completing our GL accounts. So step one, we're going to work with our opening balance for our accounts payable. So accounts payable is a liability. It's on the credit side here of our balance sheet on the left. So we're going to record our opening balance on the credit side of our GL. 1st of August. Oops. Balance 3K. Now, a quick refresher with our rules of double entry. Accounts payable is a liability account. Anything that increases a liability will be a credit entry. Anything that decreases it will be a debit entry. So if we refer to the second point on the left here, all accounts payable will be settled during August, which includes a $200 discount. Now, so therefore that $3,000 will be totally settled. So therefore we're reducing the amount we owe our suppliers. So when we decrease the liability, that's a debit. But that reduction in the liability is a combination of the funds that we're going to pay from our bank account and also some discount revenue, given this satisfies the criteria for revenue, because that $200 discount is reducing our liability and increasing our OE in terms of profit. So therefore, we're going to cross-reference that with our discount revenue account. So therefore, the combined effect of those two is that the liability is going down by the full amount from the starting balance, 3K. Next thing we need to record in our GL for accounts payable is down here. We've got 10K plus GST for our credit purchases for the month. So therefore our liability is increasing as a result of these purchases, not just for the 10K, but also that GST. So therefore we're going to credit our accounts payable because our liability is increasing. Cross-reference is inventory / GST clearing. 10K for the inventory, 1,000, 10% of 10,000 for the GST gives us a combined amount of 11K. Now, if we had any purchase returns, which we don't, they would go on the debit side because that would reduce our liability owing to our suppliers. But this ledger's done. Total debits equal 3K, our total credits equal 14K, 14 minus 3 gives you a final balance of 11. That 11K would be reported in the end of August balance sheet. So up here on the left, we would update this to 11K. Moving on to accounts receivable. Accounts receivable is an asset, represents a future economic benefit. These credit customers are going to pay us funds sometime in the next 12 months. So our opening balance for accounts receivable, 5K on the debit side of the balance sheet. So it goes on the debit side of our GL account. 1st of August. Okay. Now have a look at the first point here. For the accounts receivable at the end of the previous period, 2% of the balance will be written off as a bad debt. So it's right here. I need that disclaimer that I'm pitching this for my Unit 2 class. Unit 3-4 students, you'll be treating this a little differently in terms of factoring in allowance for doubtful debts. But that 2% that's been written off is reducing our asset. So again, our rules of double entry, when we increase an asset, it's a debit, and when we decrease it, it's a credit. So we need a credit entry here in our AC receivable account, bad debts. We need to work out what 2% of that opening 5K balance is. So on your calculators or phones, 5,000 times 0.02, or let's do it in our head, 1% of 5k is 50, 2% will be 100. Okay, at the end of the month. I'm not going to be picking on dates with this one. Then if we read on, it says the remainder of that 5k will be paid off along with a discount. So we treat this similar to what we did up here with our accounts payable. We've got bank, because that's where the funds are going to be received. And we need to acknowledge that there's a discount expense here because we've got a reduction in the account receivable asset and our OE decreasing our profit. Now, in terms of the amount, 4,900 is the amount that is owed, 5,000 minus the bad debt. So therefore, we record this as 4,900. Now we've zeroed off our balance because our customers have fully settled. Okay, the next thing is if we go down to another third point here, we've got some credit sales forecasted for August, 12,000 plus 10% GST. So these credit sales, buy now, pay later, this is increasing our assets because we'll get a future economic benefit when we receive those funds. An increase in an asset is a debit entry. And again, we need to have reference two accounts here. 12k for the credit sales plus 10% of that for the GST clearing. 12,000 times 1.1 gives us 13,200. Okay. 2 points after that, it references some sales returns. So our credit customers have returned some faulty goods for 400 plus 10% GST. So this is reducing our asset because we can't expect our customers to pay for goods they no longer have that they've returned, and we need to factor in that GST. So we do a similar thing to what we did with that credit entry, but we're going to create an account called sales returns. And we also need to acknowledge the GST effect. I'll just make that a little bigger. Let's go size 10. Okay, so 400 for the negative revenue plus 40 for the GST means we have a 440 reduction in our asset. So that's it for this ledger. So our total debits are 18.2 minus our total credits 5440 gives us a final balance of 12,760. So that's the figure that would be reported in our balance sheet. Let's move on to bank. So if we go over to our current assets, there's no bank account. So let's go to our current liabilities. We've got a bank overdraft opening balance. So that represents a liability in this case because we've overdrawn our account. We owe funds to the bank. And so because it's on the credit side and it's a liability, we need a credit balance at the start for our bank, not as a negative figure. We simply record it on the credit side, 7.5k. Now, if we look right down the bottom here, we've got cash payments forecasted for August are 11,250. So those cash payments, which is made up of some of the detail here for wages, utilities, petrol, etc., mortgage, that type of thing, all of that's been combined into this one entry. So we only need one entry for all our payments, 11,250. These payments are reducing our bank balance. They're reducing our asset. So therefore, when we decrease an asset, that is a credit entry. In terms of our cross-ref, we just cross-reference with cash payments, which factors in all the multiple ledgers that are impacted by that. And our amount is 11,250. Now, cash receipts, next line, forecasted to be 13,890. So these cash receipts, money coming into the business, asset is increasing since our bank balance, so therefore we're going to record that as a debit. Cash receipts, end of August. That's it for the bank. Our total credits equal 18,750, so that's more than our total debits. So to work out our final balance, total credits minus total debits means that in this case we are going to have a $4,860 overdraft because it's a credit balance. So that would reappear for our end of August figure in our current liabilities. Okay, GST clearing and inventory, these ones are a bit meaty. Let's start with our opening balance. So we've got 3,500 here on the credit side. Be careful of GST. It could be refundable and then we put it on the debit side, but we just simply work with what side it's on the balance sheet. 3,500 on the credit side, so there's our opening balance. Okay. Now, if we look towards the bottom here, there's a settlement made on the 1st of August. So therefore, that is going to reduce that GST liability. We've basically squared the slate with the ATO. And again, when a liability is decreasing, that is a debit entry. So 1st of August, the payment is made. And our cross-reference is bank. Those funds are just simply going to come out of our bank account when we settle up with the ATOs. So at this point, our GST balance is zero. Our debits equal our credits. Okay, now while we're down the bottom here, let's deal with these last 2 points. Let's start off with GST receipts. So those GST receipts on the cash sales, we're collecting them on behalf of the ATO, and so therefore that's going to increase our liability to the ATO when we do our BAS. So therefore, when we increase a liability, that's a credit entry. And again, our cross-reference is bank. That's where the funds are going to appear in our bank statement. So 840. Payments will be the opposite. So when we have GST on our payments for some of these items up above here, so some GST on utilities, petrol, etc., all of those are being combined here. GST payments for August 350. So that actually offsets the GST we owe. So that's reducing our GST liability. So therefore, when a liability goes down, debit entry. Again, another cross-reference with bank. Gets a little bit confusing here because we've got 2 entries on the same side, one for the settlement and one for the GST payments for the month. Okay, we're not done. Let's go back up to the 3rd point here. We had some credit sales and there was a GST impact on that. So that GST that we charge to our credit customers, we will have to collect that and then forward that to the ATO. So 10% of 12 grand is 1,200. 1,200 increasing our GST liability, so that's a credit entry. Our cross-reference is accounts receivable. That's where we're going to get those funds from. Okay, then we have some, if we go down to this sales returns point, we're going to do the opposite of what we just did there. That's those sales returns. We need to reduce what the accounts receivable are going to pay us. So that's actually going to reduce our GST liabilities since those sales have been negated. So again, another cross-reference to accounts receivable. 10% of 400 is 40. So we just get a very small offset there for that return. Then we had some inventory purchased during the month. So 10% of 10 grand is 1K. Given it was a purchase, this GST that's been charged on these purchases will offset our GST liability. So this is going to reduce our balance. So therefore, a decrease in a liability is a debit entry. So our cross-reference will be accounts payable on the debit side for 1,000. Okay. Now, there's a few other items that could appear in our GST account if we have purchase returns, etc. And a credit purchase of an NCO. We don't have that. That's it. So therefore, we total up our debits 55.40. We total up our our credits. Total up our debits 48.90. The credit side wins. So to work out our final balance, we just take that total credits figure, subtract our total debits, and we end up with 650 as our GST liability. That will go on the credit side of the balance sheet. Okay, the last account, inventory. So step one, put in your opening balance. Inventory is an asset, future economic benefit when you sell it for a marked up value. So entry is balance, 1st of August is 10K. All right, lots of possible entries for inventory. Our first one, we need to make a note of the fact that the markup on all sales is 100%. So when we get the sale price, to work out our cost of sales, we can just halve that revenue figure. Ignore the GST, that's not relevant to cost of sales. So if we go to this first sale here, credit sales is 12K. So therefore our cost of sales on that will be 6. 100% markup means if we bought it for 6K, we added 100% markup. 100% of 6K is 6K. So therefore you'd get 12, add those two together, you get 12 grand in revenue. So again, just remember, whenever you've got 100% markup, your cost of sales will always be half your revenue. So let's go over to our inventory account. Those costs of sales are reducing our inventory because we've basically supplied the customer. So that inventory has exited the business, and therefore we just cross-reference that with cost of sales, 6K. All right, we also had some cash sales for 8,400, so same drill. Cost of sales, we just halve that figure, 100% markup, half of 8,400, 4,200. Don't forget the sales returns. There's a cost price effect on that with 100% markup. So the sales returns were 400. Half of that is 200. That inventory is coming back into the business. We're presuming we can resell it. So inventory going up means we've got a debit entry. Cost of sales, which will reduce these two figures when you're trying to work out your GP in your income statement. Okay. A few other things that can affect your inventory account. So let's have a look at this one here. We've bought 10K worth of inventory on credit for this one here, all on credit. So that's inventory coming into the business, asset increasing, that's a debit entry for 10K. And our cross-reference there will be accounts payable, because we bought it on credit and we owe our suppliers money for the inventory we purchased on credit. Okay, then we go down to this fifth last point. We've done account, stock take, and we've got an inventory gain of $200. So therefore that inventory gain means that we've got an increase in our assets. We've probably undersupplied a customer or maybe an oversupply from a supplier. So asset going up is a debit entry. I'm going to cross-reference that with inventory gain. Okay. Then other possibilities on the credit side, we could have drawings of inventory, we could have an inventory loss, etc. We could have cash purchases of inventory. We don't have any of those, so we're done. So if we total up our debit entries, we've got 20,400. Total up our credits, 10.2. Debit total minus our credit total gives you a final balance of 10,200. That's the figure that goes in our August balance sheet.